Ever wondered how to make your money work for you, earning while you sleep? Imagine a life where your money works for you with dividends depositing into your account like clockwork. This isn't just a dream, it's an achievable reality. Living off investment dividends offers a path to financial freedom, providing a steady income without the daily grind. Understanding dividends. Let's talk about dividends. Imagine you have a small piece of a big company. When the company does well and earns money, they share some of that money with you. This money that you get is called a dividend. It's like getting a thank you gift for owning a part of the company. Now let's see how it works with an example. Think about a friend named David. David buys some shares in a company, which means he owns a little bit of that company. When the company makes a profit, they decide to give some of that money back to their shareholders, like David, as dividends. Companies don't have to give dividends, but many do because they want to keep their shareholders happy. If you own shares, you might get dividends every 3 months. This is called a quarterly dividend. Some companies give dividends once a year and others might do it more often. How do we know how much money we'll get? There's something called dividend yield, which helps us understand this. It's like a math formula that tells us how much money we can expect to get from our dividends compared to the price we paid for the shares. Here's how you calculate it. You take the money you get from dividends in a year and divide it by how much you paid for the shares. This gives you a percentage that shows how good the dividend is. For example, if David's shares are worth $100 each, and he gets $5 a year from dividends, his dividend yield would be 5%. That means for every $100 David invested, he gets $5 back every year just from dividends. Dividends are a great way to earn money from your investments because you get regular payments without having to sell your shares. It's like having a money tree that keeps giving you fruits every year, without having to plant new seeds. Now that we understand how dividends work and the benefits they can offer, let's explore 3 specific strategies that can help David, and investors like him, maximize their dividend income. First, consider investing in covered call ETFs, which offer the dual benefit of stock ownership and income from selling call options. Next, we have high-yield REITs that focus on real estate investments, providing substantial returns through rental and lease incomes. Lastly, the strategy involving Dividend Aristocrats involves investing in well-established companies known for consistently increasing their dividends annually. Each approach provides unique benefits and can make a significant difference in achieving financial freedom through dividends. Let's move on. Strategy 1. Covered Call ETFs. Let's dive into a smart way to make money with something called Covered Call ETFs. While it might sound complex, it's actually a very cool strategy that can help you boost your investment earnings significantly. What is a Covered Call ETF? Think of ETFs as baskets of various stocks. Instead of buying individual stocks, when you buy a share of an ETF, you're essentially buying a small piece of each stock in that basket. This spreads out your risk because your investment isn't tied to the success of just one stock. How covered call ETFs work. Owning stocks. Like regular ETFs, covered call ETFs own a collection of different stocks. Writing calls. Here's where covered call ETFs add a twist. They sell what are known as call options on the stocks they own. A call option is basically a promise that lets someone else buy a stock at a specific price before a certain date. Earning premiums. Every time the ETF sells these call options, it earns money known as premiums. This is extra cash on top of any dividends the stocks might pay. Suppose David invests in a covered call ETF. This ETF not only earns money from any dividends its stocks pay, but also from the premiums from selling call options. It's like getting 2 streams of income from the same investment. Covered call ETFs generally offer higher dividends because they generate additional income from the call options. However, there's a catch. If the stock prices increase significantly, the ETF might miss out on some potential profits since it has to sell the stocks at the agreed-upon price in the call options. Yet, the regular income from the premiums often balances out these risks. Investing in covered call ETFs can be likened to having a steady job with a regular paycheck and occasional bonuses. For David, this strategy can be an excellent way to earn more from his investments with a balanced level of risk. Having explored how covered call ETFs can enhance David's dividend earnings with their combination of stock ownership and option premiums, let's now shift our focus to a different type of investment that offers potential for even higher returns: high-yield REITs. Strategy 2. High-yield REITs. REIT stands for Real Estate Investment Trust, which allows you to invest in large real estate properties like shopping malls or apartment complexes without the hassle of managing them yourself. What are high-yield REITs? REITs are companies that own or finance income-generating real estate. By investing in a REIT, you essentially become a part owner of these properties, earning a portion of the income they generate through rents or leases. How high-yield REITs work. Property ownership. REITs manage various property types: commercial, residential, healthcare facilities, and more. These properties generate revenue primarily through leasing and rent. Dividend payments. By law, REITs must distribute at least 90% of their taxable income to shareholders in the form of dividends, often resulting in higher yields compared to other investments. High-yield REITs are called high-yield for a reason. They typically offer higher returns on investment. For instance, if David invests in a high-yield REIT with numerous residential buildings, he benefits from the continuous rent payments made by tenants, translating into substantial dividends. However, these investments are not without risks. Economic downturns or reduced rental activity can lower the income these properties generate, potentially reducing the dividends paid to investors like David. Why consider high-yield REITs? Despite the potential risks, high-yield REITs are appealing for their ability to provide regular, higher-than-average dividends. They represent an attractive option for investors seeking consistent income, making them a viable strategy for enhancing one's investment portfolio and working towards financial independence. High-yield REITs offer a unique blend of regular income and potential high returns, making them an essential consideration for investors like David seeking to diversify and strengthen their investment strategies. After examining how high-yield REITs can provide robust returns through real estate investments, let's turn our attention to another proven strategy that offers stability and consistent growth in dividends: investing in Dividend Aristocrats. Strategy 3. Dividend Aristocrats. Finally, let's talk about another cool way to make money through investing called Dividend Aristocrats. Imagine a club where only the most reliable and strong companies are allowed to join. These companies have a special power. They have been able to increase the amount of money they give back to their shareholders every single year for at least 25 years. These companies are called Dividend Aristocrats. What makes them special? Dividend Aristocrats are like the champions of giving back money. They belong to a group that's part of the S&P 500, which is a list of 500 large companies in the US, because they have been increasing their dividends for so many years. People trust them a lot. They're known for being stable and reliable, even when the economy isn't doing so well. How do they work? 1. Consistent dividends. Every year, these companies not only pay dividends, but they also increase the amount they pay. This is really good for investors because it means they can count on getting more money over time. 2. Long history of success. These companies have been successful for a long time, which makes them feel safer to invest in. They include famous names that you might hear about like Coca-Cola or McDonald's. Since these companies increase their dividends every year, David can expect to get a little more money each year. Because these companies are well established and financially strong, they're less likely to run into big problems. This makes them a safer choice compared to newer or less stable companies. Suppose David decides to invest in a few of these Dividend Aristocrats. By spreading his investment across different companies, he can reduce his risk. Even if one company doesn't do well, the others might still do great, keeping his income steady. How much to invest? David doesn't need a huge amount of money to start. He can buy a few shares and add more over time. The key is to be patient and consistent with his investments because building wealth this way takes time. Each strategy not only diversifies David's investment portfolio, but also enhances his potential for steady and increased income. Whether through the additional income from option premiums, the high returns from real estate assets, or the dependable growth from well-established companies, David is well-positioned to achieve his financial goals. By carefully selecting from these strategies, David can enjoy a mix of immediate income, growth potential, and long-term stability, making significant strides towards financial freedom through dividends. Remember, the key to successful investing is to start early, stay informed, and keep learning about new opportunities. So why not start exploring these strategies today and see how they can help you build a brighter financial future?